Something extraordinary just happened in the gold market. And I'm not talking about another all-time high or some analyst's prediction. I'm talking about a fundamental restructuring of how gold trades, who's buying it, and why the old playbook you've been following for years might be completely obsolete. For decades, gold moved in predictable patterns. When the dollar strengthened, gold fell. When interest rates rose, gold dropped. When inflation cooled, gold retreated. These were the iron laws of gold trading. Every analyst knew them. Every investor relied on them. And for years, they worked until they didn't. Look at what happened recently. The Federal Reserve raised interest rates to levels we haven't seen in over 2 decades. Traditional gold analysis said this should crush gold prices. Higher rates mean higher opportunity cost for holding non-yielding assets like gold. It's economics 101. Except gold didn't crash. It rallied. It hit record highs while interest rates were climbing. That's not supposed to happen. Then look at the dollar. The dollar index strengthened significantly. Again, traditional analysis says strong dollar equals weak gold. They're supposed to move in opposite directions. It's one of the most reliable inverse correlations in financial markets. Except gold kept climbing alongside the dollar, both moving up together, defying decades of established correlation. Something fundamental has changed. And if you're still analyzing gold through the old lens, you're missing the biggest shift in precious metals markets in over 50 years. Let me show you what's really happening. Central banks have become the dominant force in gold markets. Not hedge funds, not retail investors, not even the big institutional players. Central banks, and they're buying gold at a pace we've never seen before in modern history. For 15 consecutive years, central banks have been net buyers of gold. But here's what's critical. The buying accelerated dramatically starting in 2022. We're not talking about modest increases. We're talking about central banks purchasing over 1,000 tons of gold annually. That's roughly 32 million ounces every single year. And the pace isn't slowing down. Think about what that means. These aren't traders looking for quick profits. These aren't speculators betting on short-term moves. These are the world's most powerful financial institutions making strategic, long-term decisions about the future of the global monetary system. And they're voting with their reserves. They're voting for gold. Who's leading this charge? China's central bank has been adding gold to its reserves month after month. The People's Bank of China reported 18 consecutive months of gold purchases. But here's what's interesting. Many analysts believe China's actual gold holdings are significantly higher than officially reported. Why would they underreport? Because they don't want to signal their full strategy to the market. They don't want to drive prices up before they've finished accumulating. Poland's central bank has been aggressive. They've increased their gold reserves substantially, bringing their holdings to over 200 tons. The National Bank of Poland explicitly stated they're diversifying away from dollar-denominated assets. They're not hiding their strategy. They're openly declaring they want less exposure to the dollar system. Turkey has been buying. India has been buying. Singapore has been buying. Even countries you wouldn't expect are quietly adding gold to their reserves. This isn't a regional phenomenon. This is global. This is coordinated. Not in the sense of some conspiracy, but in the sense that central banks around the world are independently reaching the same conclusion. They need more gold. Why? What do they see that the average investor might be missing? They see a global monetary system under stress. They see record levels of sovereign debt. They see currency debasement happening in real time. They see geopolitical tensions rising. They see the weaponization of the dollar through sanctions. And they see gold as the ultimate neutral reserve asset that no single country controls. Let me give you a specific example of how dramatic this shift is. In the 1990s and early 2000s, central banks were net sellers of gold. They thought gold was a barbarous relic. They believed the dollar system was permanent and stable. The Bank of England famously sold half of Britain's gold reserves between 1999 and 2002 at prices around $250 per ounce. They sold 400 tons. Today, that gold would be worth over $30 billion. They sold it for about $3.5 billion. That decision is now called Brown's Bottom, after Gordon Brown, the chancellor who authorized the sales. It's considered one of the worst financial decisions in British history. What changed? Why did central banks go from selling gold to buying it aggressively? 2008, changed everything. The global financial crisis revealed the fragility of the banking system. It showed that institutions everyone thought were rock solid could collapse overnight. It demonstrated that the entire financial system was built on leverage and confidence, and when confidence evaporated, the system nearly imploded. Central banks responded with unprecedented monetary expansion, quantitative easing, zero interest rates, negative interest rates in some countries. They printed trillions of dollars, euros, yen, and yuan. They bought government bonds, corporate bonds, even stocks in some cases. They did whatever it took to keep the system functioning. But here's what they understood. You can't print gold. You can create dollars with a keystroke. You can expand your balance sheet infinitely. But you cannot create gold. There's a finite amount of it. And that scarcity makes it valuable as a reserve asset when every other currency is being debased. Fast forward to 2020. The pandemic hit. Governments and central banks responded with even more aggressive monetary and fiscal stimulus. Trillions more in spending. Trillions more in money creation. And central banks watched their own balance sheets explode to levels that would have been unthinkable just years earlier. They know what happens next. They've studied monetary history. They know that when you dramatically expand the money supply, you eventually get inflation. You get currency devaluation. You get loss of purchasing power. And they know that gold is the asset that preserves value through those periods. But there's another factor driving this pivot. Geopolitics. The world is fragmenting into competing blocs, the United States and its allies on one side, China, Russia, and their partners on the other, and many countries trying to navigate between these poles. When Russia invaded Ukraine, the West responded with unprecedented financial sanctions. They froze Russian central bank reserves held in dollars and euros. Think about what that means. Russia had accumulated hundreds of billions in foreign currency reserves. They thought those reserves were safe. They thought they could access them whenever needed. And then, overnight, those reserves were frozen, inaccessible, weaponized. Every central bank in the world watched that happen. And they asked themselves a critical question. Could that happen to us? If we have a dispute with the West, could our dollar reserves be frozen? Could our access to the international financial system be cut off? Gold can't be frozen. Gold held in your own vaults, in your own country, is beyond the reach of sanctions. It's sovereign. It's neutral. It's the ultimate insurance policy against financial warfare. This is why countries that might face Western sanctions are buying gold aggressively. This is why even countries allied with the West are diversifying into gold. Because the rules of the game have changed. The dollar system, which seemed permanent and stable, now looks like it has political risk attached to it. Now let's talk about what this means for gold prices. When central banks are the marginal buyer, the dynamics change completely. Retail investors and hedge funds are price sensitive. When gold gets expensive, they sell. When it gets cheap, they buy. They trade around positions. They take profits. They cut losses. Central banks don't trade. They accumulate. They're not looking at quarterly returns. They're thinking in decades. They're building strategic reserves for the long-term stability of their monetary systems. Price is secondary to the strategic objective. This creates a floor under gold prices. Every significant dip gets bought by central banks. They're not trying to time the market. They're systematically adding to reserves. This is why gold has been so resilient even when traditional indicators suggested it should fall. But here's where it gets really interesting. The physical gold market is tight. Really tight. When central banks buy 1,000 tons of gold annually, that gold has to come from somewhere. It comes from mine production, which is relatively stable. It comes from recycling, which is limited. And it comes from existing holders selling. But what happens when existing holders don't want to sell? What happens when Western investors, who have been relatively indifferent to gold for years, suddenly wake up to what central banks have been doing? What happens when they realize that the world's smartest money has been accumulating gold while they've been chasing tech stocks and crypto? You get a supply squeeze. You get a situation where demand far exceeds available supply. And you get prices that move much higher, much faster than traditional models predict. We're already seeing signs of this. The premium for physical gold over paper gold has been widening. In some markets, you pay significantly more for actual metal than the spot price suggests. That's a sign of physical tightness. That's a sign that the paper market, where most gold trading happens, is disconnected from the physical reality of supply and demand. Let me explain how the gold market actually works, because this is crucial to understanding what's happening. Most gold trading happens in the paper market. Futures contracts, ETFs, derivatives. These are claims on gold, but they're not physical metal. The COMEX in New York and the LBMA in London handle enormous volumes of paper gold trading every day. Hundreds of times more gold trades on paper than actually exists in physical form. This system works fine when everyone trusts that paper claims can be converted to physical metal if needed. But what happens when that trust erodes? What happens when major players start demanding physical delivery instead of rolling paper contracts? We saw a glimpse of this during the pandemic. In March 2020, the gold futures market experienced severe stress. The spread between futures prices and physical prices blew out to unprecedented levels. At one point, gold futures were trading $40 to $60 below the spot price of physical gold. That's backwards. That's not supposed to happen. It happened because there were concerns about the ability to deliver physical metal. The market stabilized, but the episode revealed the fragility of the paper gold system. It showed that in times of stress, physical gold and paper gold can decouple. And if you're holding paper claims when that happens, you might not be able to convert them to physical metal at the price you expect. Central banks understand this. That's why they're buying physical gold, not ETFs. That's why they're repatriating gold from foreign vaults to their own countries. Germany spent years bringing its gold reserves home from New York and London. The Netherlands did the same. Austria, Belgium, and other countries have followed. They want physical metal in their own vaults, under their own control. This repatriation trend is another signal of the pivot. It suggests declining trust in the traditional custodial arrangements. It suggests countries want direct control over their reserves, and it removes gold from the pool of metal that can be used to support the paper market. Now let's talk about what this means for you. If you're sitting on significant retirement savings, if you have wealth you want to preserve, you need to understand what's happening. The world's central banks are telling you something. They're showing you through their actions what they believe about the future of money. You might be thinking about how to protect your retirement accounts from what's coming. A lot of people don't realize you can hold physical gold inside a retirement account without triggering taxes or penalties. It's called a gold IRA. I put together a free guide that explains exactly how it works, what the rules are, and how to set one up properly. It's in the description below. If you've got $100,000 or more in retirement accounts, it's worth understanding this option. Just something to consider as you're thinking about portfolio protection. But back to the bigger picture. The pivot we're seeing isn't just about gold prices going up. It's about a fundamental restructuring of the global monetary system. For 70 years, the dollar has been the undisputed reserve currency. Countries held dollars. They traded in dollars. They priced commodities in dollars. The dollar was the foundation of international finance. That system is eroding, not collapsing overnight, but gradually losing its monopoly status. Countries are trading in their own currencies. They're settling transactions outside the dollar system. They're building alternative payment networks, and they're backing their currencies with gold reserves. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been discussing a gold-backed currency for international trade. Whether that actually happens or not, the fact that they're discussing it is significant. It shows they're looking for alternatives to dollar dominance, and gold is central to those alternatives. Think about what happens if even a fraction of international trade shifts away from dollars. Think about what happens to dollar demand. Think about what happens to the value of dollar-denominated assets. And think about what happens to gold as countries need more of it to back their currencies and facilitate trade. The implications are enormous. We're not talking about gold going from $2,000 to $3,000. We're talking about a potential revaluation of gold relative to all fiat currencies. We're talking about gold potentially playing a formal role in the international monetary system again, something it hasn't done since the early 1970s. Let me take you back to that period, because there are parallels to today. In the 1960s, the United States was running large fiscal deficits to fund the Vietnam War and domestic programs. Other countries were accumulating dollars and becoming concerned about American monetary policy. They started converting their dollars to gold under the Bretton Woods system, which guaranteed convertibility at $35 per ounce. The problem was, the United States didn't have enough gold to back all the dollars in circulation. The gold coverage ratio was declining. Foreign central banks knew this. They knew the $35 peg was unsustainable. So they accelerated their conversions, trying to get gold before the system broke. In August 1971, President Nixon closed the gold window. He ended dollar convertibility to gold. It was supposed to be temporary. It became permanent. The dollar became a pure fiat currency, backed by nothing except the full faith and credit of the United States government. What happened to gold prices? They exploded. Gold went from $35 in 1971 to over $800 by 1980. That's not a 20% gain. That's not a double. That's a 23 times increase in less than a decade. Now, I'm not predicting gold goes up 23 times from current levels. The circumstances are different, but the underlying dynamic is similar. You have a reserve currency under stress. You have fiscal deficits that seem unsustainable. You have foreign central banks losing confidence in the system. And you have gold as the alternative. The difference today is that we're not on a gold standard. There's no official peg to break. But there's an unofficial understanding that gold is worth roughly what it trades for in the market. What happens if that understanding changes? What happens if central banks collectively decide gold is significantly undervalued relative to the amount of currency in circulation? Some analysts have done the math. If you wanted to back even a fraction of global money supply with gold at current prices, you'd need far more gold than exists. The only way to make the math work is for gold prices to be much, much higher. Some estimates suggest gold would need to be $10,000, $20,000, even $50,000 per ounce to properly back the monetary system. Will we get there? I don't know. But I know that central banks are acting like gold is more valuable than current prices suggest. I know they're accumulating aggressively. I know they're building reserves for a reason. And I know that when the world's smartest money is moving in one direction, it's worth paying attention. There's another factor we haven't discussed yet: mine supply. Gold production has been relatively flat for years. It's incredibly difficult and expensive to find and develop new gold mines. It takes a decade or more from discovery to production. And the easy gold has already been found. New discoveries are deeper, lower grade, and more expensive to extract. This means supply is relatively inelastic. When demand increases, supply can't quickly respond. Unlike oil, where producers can drill more wells and increase output relatively quickly, gold supply is constrained by geology and the long lead times for mine development. So you have inelastic supply meeting surging demand from central banks. You have a physical market that's tightening. You have geopolitical tensions driving safe haven demand. You have inflation concerns driving retail demand. And you have a growing recognition that the old correlations don't work anymore. This is the pivot. This is the shift. Gold is transitioning from a traded commodity to a strategic reserve asset. It's moving from the periphery of the financial system back toward the center, and the implications of that shift are just beginning to play out. What should you do with this information? That depends on your situation, your risk tolerance, and your investment objectives. But at minimum, you should understand what's happening. You should recognize that the gold market is fundamentally different than it was 5 or 10 years ago. You should know that central banks are the dominant force now, and they're not trading. They're accumulating. If you own gold, this context should give you confidence to hold through volatility. Short-term price swings don't matter when you understand the long-term structural shift. If you don't own gold, this might be the time to consider adding some exposure. Not as a trade, but as a strategic allocation, as insurance against monetary instability, as a hedge against the risks that central banks are clearly worried about. Think about your portfolio. Think about what you're exposed to. If you're heavily weighted toward financial assets, stocks, bonds, cash, you're fully invested in the current monetary system. You're betting that system remains stable. You're betting that currencies maintain their value. You're betting that the pivot we're seeing doesn't accelerate into something more dramatic. Maybe that's the right bet. Maybe the system muddles through. Maybe central banks are overreacting, but what if they're not? What if they see something coming that most investors are missing? What if the accumulation of gold by the world's most powerful financial institutions is a signal you should heed? The beauty of gold is that it doesn't require the system to collapse to be valuable. It doesn't require hyperinflation or currency crisis. It just requires continued uncertainty, continued monetary expansion, and continued central bank buying. All of those trends are firmly in place. All of those trends are likely to continue. And here's the thing about pivots. By the time everyone recognizes them, they're already well underway. By the time it's obvious that gold's role in the financial system has changed, prices will have already adjusted. The opportunity is now, while most investors are still analyzing gold through the old framework, while they're still waiting for interest rates to fall or the dollar to weaken before buying gold. Central banks aren't waiting. They're buying now. They're accumulating at every price level. They're building reserves for what they see coming. And they have access to information and analysis that far exceeds what any individual investor has. You don't have to match their conviction. You don't have to allocate the same percentage of your portfolio that they're allocating to reserves. But you should at least consider whether they might be onto something. You should at least ask yourself why the world's smartest money is moving so decisively into gold. The pivot has started. The shift is underway. The gold market is fundamentally different than it was just a few years ago. And the investors who recognize this early, who position themselves ahead of the crowd, are the ones who will benefit most from what comes next. This isn't about getting rich quick. This isn't about timing the perfect entry point. This is about understanding a major structural change in global finance and positioning yourself accordingly. This is about recognizing that when central banks collectively change their behavior, when they pivot from selling gold to buying it aggressively, when they repatriate reserves and build strategic stockpiles, they're telling you something important about the future. Are you listening? Are you paying attention to what their actions reveal? Or are you still analyzing gold through the old playbook, waiting for signals that may never come, missing the pivot that's happening right now? The choice is yours, but the pivot has already started. The question is whether you'll recognize it in time to benefit from it, or whether you'll look back years from now and realize you missed one of the most significant shifts in financial markets in your lifetime. The world's central banks have made their decision. They've shown you what they believe through their actions. Now it's your turn to decide what you believe and what you're going to do about it.